Assalamualaikum warahmatullahi wabarakatuh and a very good morning I bid to everyone. Today my group will present about money market instrument which is Islamic acceptance bill, Australian Treasury bonds and also Australian Treasury notes. My name is Nurul Saherra Binti Muhamadin. My matric number is 253170. First of all, I will explain about the definition of Islamic Acceptance Bill or can be known as a ABI. ABI is a bill of exchange drawn by bank, accept or draw by customer, and accept by bank on a specific future date that agree by both parties. ABI is based on the interest-free in underlying contract. This ABI instrument has two types which is import and local purchaser and also export and local sales. ABI purchase can be defined as a bill of exchange where customer will go to the bank that provide a financing to them in order to purchase the good and the price will paid in the lump sum at maturity date. Second is ABI sales. Bank will buy a client debt with a security under the bill of exchange. Next is the purpose of ABI creation. It is a way to purchase goods without borrowing money and this instrument become a guaranteed form of the payment. It also used in the trading transaction between the seller and the buyer. How ABI is created. The creation of ABI is based on the Bank Negara Malaysia guideline. The creation of this instrument starts when the bank can arrange the acceptance of the financing facility. For the specific creation of ABI, it can be seen in the case of ABI purchase when this instrument can be drawn and accepted by purchaser, while for the ABI sale, it can be drawn by the seller. Okay, who are the parties that involved in this ABI instrument? There is three parties which is purchaser or importer, seller or exporter and also the bank. In import and local purchase, the party that involved is importer and drawing bank only. This is because the purchaser accept the ABI from the drawing bank. For the export and local sales, it involves exporter and accepting bank because seller will draw ABI and accepting bank will accept the ABI. Okay, the right for each party. Okay, the right of purchaser in ABI instrument is they need an agreement with the bank in order to get import financing facility and also they need to know the detail of the profit margin, price and other costs that incurred at the time of sale agreement. Second is seller. Seller have the right to know the price of the discount and other costs before they buying the product. Last is bank. Bank can be a drawer or acceptor of ABI. Bank have the right to reject or accept ABI when customer do not fulfill the requirement and also bank need to receive their payment at the maturity date from the seller and purchaser that use their service. Next is responsibility or obligation of each party. First is purchaser. They need to fulfill all the requirements stated in BNM guideline and this ABI purchase can transfer the payment at the maturity date that both parties agreed. Second is seller. They also need to pay the exactly amount agreed by both parties in a maturity date and seller must meet all the requirements based on BNM guideline. For the bank, accepting bank need to accept ABI that meet the requirement and drawn by the seller, while the drawing bank, once the request of the purchaser is approved, bank must proceed the transaction and make the payment to the seller at the value stated in the instrument. Okay, the risk that faced by each party. First is purchaser. It involves a risky situation where seller need to make a payment as a representative to the purchaser. For the seller, it will face transaction risk where purchaser did not know the error or inability of the seller to deliver the product. Last is bank. Bank will face a default payment by their customer who do not make a payment, either importer or exporter. Next is return or benefit to each parties. First is purchaser. The benefit using this ABI because it's safe and do not give an advance payment to seller before getting the product. Second is seller. The benefit that seller can receive when using this ABI instrument is getting a guaranteed payment before the good will ship out. Last is bank. Bank will get a profit as a return because customer use their service to make the payment. Okay, last but not least, what is the pricing mechanism in ABI instrument? The minimum amount of ABI instrument is 50,000 ringgit Malaysia and in multiples of 1,000 ringgit Malaysia where the face value may be equal but shall not exceed the amount of trading transaction that is indicated in the supporting document. So that's all from me.
How is the Islamic acceptance bills traded? Islamic acceptance bills Bank Negara Malaysia. By an Islamic scheme, the approved bill I, or which known as ABI, engage in both domestic and international markets. The ABI constructed from murabahah on the basis of the Sharia principles, which imply cost plus and buy-in for debt trading. We have two methods, which is for first one imports and local purchases, and then the second one export and local sales. Alright, for the first one, imports and local purchases, working capital support under Murabahah is an effective financing method. According to this concept, the bank designs the clients as the buying agent of the bank. Instead, in the case of the store, the buyer orders the item to the dealer and charge the vendor a premium for them at a rate which is always competitive. Customer the organization enjoys as increased billing period of up to 365 days. The customer charges the bank as expense for the products plus the profit margin until the murabahah is done. Debt forms are the sales of product by bank to the borrower for late payment. The loan shall be protected in the form of bills of exchange drawn and approved by lending corporation for the full sale price payable to the borrower. If the bank would like to supply the ABI to a third party, the ABI shall be moved to the Biden Act. Alright, for the second one, export and local sales. This type of funding facility is used for relevant Sharia definition. The payment documents must be submitted in compliance with the selling contract or the credit card. Send the buyer's bank selling paperwork. As a substitution bill representing ABI, the client receives any bank bill. In theory, the bank will purchase the ABI and the profits will be added to the customer's account at a premium settled with one another. The secondary market of Islamic acceptance bills. There is a secondary market trading the Islamic acceptance bills. Trading hours in the same day prices are between 9 a.m. until 12 noon, except for trade between approved financial institution and others in Kuala Lumpur and the holiday in Kuala Lumpur. Registered financial institution will be trade amongst themselves within the period decided to with each other, like half work days and Saturdays with Kuala Lumpur on the same day value. Where and how can having the access to the Islamic acceptance bills? Customer can access this instrument from any bank, especially Islamic banks, which offer the services of Islamic banking acceptance products such as CMB Islamic, M-Bank Group, RSB Group, Afin Islamic, and Alliance banks. After that, this can be done either directly to the bank itself or through the bank official website. How does the Islamic acceptance bills used in a bank treasury operation? In a bank treasury operation, the ABI or Islamic acceptance bills facility was divided into two financing types for imports and purchases locally, as well as for export and local sales. The aim of this IAB was to provide a Sharia compliant instrument, in particular with a view to commercial finance. The IAB has been designed and included in a bank treasury procedure focused either on the postponed or low-cost lump sum concepts of al-murabaha. Moreover, buy-in involves bond exchange for the secondary market lending tool. The use of the murabaha is based on the cost-effectiveness margin or margin that both parties have agreed. In the case of a late selling of payment arising from a business's contract, by al-Dayan shall transfer the debt. Are there any official guidelines regulating this instrument, which is Islamic acceptance bills? Regulatory acts, other regulation. Islamic accepted bills is governed by the following regulations under the respective authorities, such as Bank Negara Malaysia. For the first one, Companies Act 2016, and then second one, Islamic Financial Services Act 2013, Financial Services Act 2013, Rang Undang-Undang Kewangan 2012, Takaful Act 1984, Islamic Banking Act 1983, and then the last one, Exchange Control Malaysia 1953. Alright, we continue to the official guidelines regulating these instruments, Islamic acceptance bills. The practices in these Islamic banks and financial institutions are actually regulated by three primary laws. For the first one, 1965 Company Act, CA, and then the second one, Muslim Banking Act, IBA, 1983, and then the last one, Act 1989, concerning banking and financial institutions, BAFIA, BAFIA. Who are the regulating agencies for Islamic acceptance bills? For the first one, of course, Bank Negara Malaysia, and then second one, Sharia Advisory Council (SAC), and then the last one, others, which is Laws of Malaysia. The definition for Australian Treasury bonds. Through the Australian Office of Financial Management (AOFM), Treasury bonds are medium to long-term debt securities issuing a semi-annual yearly fixed interest rate over the lifetime of the security. Treasury bonds are issued by the Reserve Bank of Australia as symbolic returns or dividends. Treasury securities in Australian dollars are denominated in arrears on a semi-annual coupon. On a redemption date at face value, Treasury bonds will be withdrawn. The purpose of the Australian Treasury bonds was created. Treasury bonds are one of the three types of Australian government securities issued by the Commonwealth of Australia through the AOFM to finance the government's spending activities. How Australian Treasury bond was created. Section 4 allows for establishing treasury bonds by lending to raise funds through the Commonwealth Engraved Fund Act 1911. Treasury bonds and other acts involving a particular borrowing authority or the Commonwealth Australian State Financial Agreement are issued in compliance with Section 3A of the Commonwealth Inscribed Inventory Act 1911. In the same way and in the condition as directly provided by the Commonwealth Treasurer of Australia. Treasury bonds are issued at some amount. In its parts, the Treasurer has authorized officers of the AOFM. Treasury bonds are issued according to the Memorandum of Document Terms and Conditions. Treasury bonds can be sold by sale, labor union bid, public subscribes, the exchange of an official investment or some other.
I am Nabila Binti Wahab 255681. I will explain about the parties involved in Australian Treasury bond. So for the issuer, the first is the Commonwealth of Australia, next is the Australian government, and the third is the company. When issued for the first time, all bonds have a fixed value. Usually it have to pay for 100 or 1000 for the bond. And when you keep the bond until maturity, it is the sum when you get back. The instrument also have the investor, which is any institutional or other big investor. They choose to invest in treasury bond because of its stability and it is very liquid. Other than that is because the Australian government pay the income regularly, they made the big investor choose to invest it. So, right of each party in Australian Treasury bond. So, for the issuer, it have the right to issue any outstanding series of Treasury bond, whether by invitation to tender or otherwise. For the investor, it has right in the Treasury bond beneficial ownership. Next, it also has the right in the form of depository interest (CDIs), meaning that any of economic incentive or rewards such as principal payment and coupon added to the legal possession of the treasury bond issued by CDI. Not only that, bondholder also have right in ownership of 100 face value per one unit holding of treasury bond that has been issued. Next, I will explain about the responsibility or obligation of each party in Australian treasury bond. So the Australian government body, which is responsible for all treasury bond management and administration in the Australian Financial Management Office, which is AOFM. Next, risk in Australian treasury bond. So, for the first risk is the market price changes. So, for the market price changes, um, if interest rate increase, the price of bond will drop because of treasury bonds market price is depend on variety factors, but mostly in interest rate general level of changes. Conversely, if interest rate fall, the price of the bond will likely go higher. Besides that, if the bond are purchased for the higher price, which is more than 100 or are sold before its maturity date, it possible for capital losses to be realized. Second, conversion by Australian government at any period with the subject of minimum time of 3 months of notice. The Australian government may convert the holding of its treasury bond that register underlying directly in the Commonwealth Stock Register. If this situation happens, the investor will continuously receive the exact amount of face value and coupon interest payment that entitled with the bond. Yet, sadly, the investor could not sell their treasury bond investment on the ASX. So, thirdly, the deflation. If deflation occur, which is a decline in CPI, it will decrease the size of coupon interest payment and nominal value that is payable to maturity. The exposure to deflation due to flow of coupon interest payment is minimal, and since the nominal value payable at maturity cannot be less than the Treasury index bond face value sum. So I will explain about the return or the benefit in Australian Treasury bond. So first, it is secure and regular income. Australian government made the semi-annual coupon interest payment to their bondholder. Second is fixed interest rate. Investors are granted the ability to gain interest at a fixed rate of investment period. Third, the liquid investment. Treasury bond can be sold at any time that investor want at the ASX market while it's open. This means that if investors are urgently need cash, they can sell their bond at market price on the ASX. And lastly is diversification, which means that if investors choose to invest in treasury bond, they have a huge opportunity to diversify their portfolio benefit. Next, I will explain about the pricing mechanism in Australian treasury bond. So it have two formula. First, the basic formula, and second is near maturity bond. Then I will explain about the how Australian treasury bond is traded. So when company need fund, they will issue bond to the investor. Australian treasury bond is traded by Commonwealth government security that issued by the Australian government. It can be purchased directly through the counter or through the AS through a broker or online trading. So next, I will explain about the secondary market for Australian treasury bond. Treasury bond may be traded in the secondary market after issue it. In the secondary market, treasury bond may be exchanged on a yield basis with the price of 100 face value determined using the formula for pricing treasury bond. The Australian Financial Market Association have remarked on the trading of long debt securities such as treasury bond in the over-the-counter market. So the example of the secondary market such as Bofa Security, ANZ Banking Group Limited. So lastly, I will explain about how to access Australian Treasury bond. The Australian Treasury bond can be directly accessed from the issuer through a public offer or primary market at the face value. Besides that, it can also be accessed for Australian Security Exchange ASX after they have been in the primary market. that known as the secondary market. Investor may ask their broker to place or order of treasury bond. After settlement of the trade may take place up to 3 business day to get it.
Okay, I will continue from my friend's presentation. My name is Alida Binti Baharin 253392 for the Australian Treasury bond. This instrument used based on Chase Depository Interest (CDI), which the owner of the Treasury bond will hold the government bond of Australia in the form of CDI, which means that the holder derive all the economic benefits, including the payments of the underlying bond, but without the permanent legal title of which remain with the nominee. Okay, the mechanism of ownership is a bit confusing, but the physical treasury bond and exchange rate treasury bond operate in the same way, which is to ensure that they maintain sufficient liquidity in both products within a few basic points of each other. The owner of the exchange rate government Australian government bonds give the holder the right to receive benefits and principal repayment payable to the underlying Australian government bonds. Okay, for official legal lines, Australian Treasury bond issued according to Section 3A of Commonwealth Inscribed Stock Act 1911 and other acts which is contain specific borrowing authority or the financial agreement between the Commonwealth and Australian state. These instruments are issued in large amount upon the direction of the Treasurer of the Commonwealth of Australia. An officer of AOFM has been appointed to exercise the power on his behalf. Treasury bond will be issued on the terms and conditions set forth in the information memorandum provided, and subject to these terms and conditions, this instrument may be issued from time to time by tender, by way of a syndicate offer, by formal subscription, by the conversion of official investment, and by such other method as may be deemed appropriate. Okay, for regulating agencies, the Australian Office of Financial Management is the agency that is responsible for the administration and management of the treasury bonds, and the treasury bonds are authorised investment under trustee legislation applying in Australia. Okay, next for Australian Treasury notes, for definition, is a short-term discounted securities denominated in the Australian dollar and are redeemable on maturity at face value, which is between 3 and 6 months, but can be up to 12 months for maximum period. The purpose is to assist the government's, Australian government's short-term funding needs, and according to AOFM, the issuance of treasury notes are through competitive tender, and for these recent years, AOFM has issued treasury notes fortnightly for the purpose of market maintenance instead of cash management purpose. Okay, Australian treasury notes is created to raise money by way of loan according to Section 4 of Commonwealth Inscribed Stock Act 1911, which also in the same act in Section 3A is containing specific borrowing authorities or the financial agreement between the Commonwealth and States of Australia. Okay, next is parties involved and right of for each party. First is issuer. Since the instrument is issued in large number, the issuer of Australian Treasury notes have the right to issue the Treasury notes according to terms and conditions as the Commonwealth of Australia directs. And for investors, in order to manage their cash profile effectively, investors have the right to fund a short-term, low-risk investments such as Treasury notes. The investor demand for treasury notes also based on the performance of the tender. Okay, then for responsibility on Australian treasury notes, in order to make sure that cash can always be able to meet financial obligation, the OFM was responsible to manage the Australian government's cash balance. Treasury notes have its own role in terms of management of cash and are more flexible as a cash management tool compared to Australian treasury bonds. Like treasury bonds, treasury notes management and administration also under responsibility of AOFM, which is an Australian government agency.
My name is Siti Syafiqah Binti Basirun. My metric number is 255705. I will continue my part, which is the risk of each party in Australian Treasury notes. The refinancing risk is actually the possibility that the borrower cannot refinance the existing debt. It is caused by the increasing of interest rate. The higher of interest rate will make the borrower not enough sufficient income. In Australian Treasury notes, the refinancing risk can be reduced by the spreading maturity over the multiple dates. By using that way, we can minimize the risk occur. The other way that we can reduce the risk is can employ the lower funding task. Next is the return or benefits to each party. The sums of the benefit is the investor do not pay for the coupon. They only need to pay the discount from the face value at the maturity date. Normally, the maturity date is starting from 3 to 6 months or can be long as 12 months. The Australian Office of Financial Management (AOFM) will manage the government cash balance. It is because to make sure that they will meet the financial obligation. For pricing mechanism in Australian Treasury note, as stated that they was traded on a yield to maturity basis. So the calculation below will include the pricing will include the yield into the pricing formula. Next is instruments traded. The Australian Treasury notes traded and quoted on a yield to maturity basis. It is referred to the return the investment that will expressed as a percentage. Next is the secondary market in Australian Treasury note. The AOFM identified that the secondary market in Treasury notes is underdeveloped. This will make it very hard and tough to recognize the market makers in the same way as for the Treasury bond or Treasury index bond. To access to these instruments, the investor can access at the Australian government or also can access at the Commonwealth of Australia. The instrument used in the Treasury operations. In Treasury operation, it is need to pay a discount from the face value at the maturity dates. The maturity date normally from 3 to 6 months, but also can be long as 12 months or 1 year. For the official guideline regulating in this instrument, it is regulated by the Australia System regulations. The settlement in Australia System is to take the place before end of the day on the business day specified in the invitation to the tender. In the Australia System regulations, this shall be logged in the Australia System in the name of the applicant. The last one is the regulating agency. The list below is the sums of the agency that regulating in this instrument. That's all from me. Thank you.